Dave Mazza, let's follow the money because it really has been flowing into ETFs. $72.5 billion so far. I think it's this year.
That's right.
What's driving it?
It's really about people being a bit fearful of taking on some of that single stock risk that we've seen, but it's also just the growth of the ETF industry. It continues because of the diversification benefits it offers, the liquidity, and of course, transparency.
Well, currency hedged ETFs and broad international ETFs, they've seen a lot of money flow into those. That said, that market, especially Europe, has turned over the past month. So will it change?
It has a bit, but as you say, people have been following the money, and what they've really been following is the quantitative easing. And that's what we've seen in Europe, in Japan, in particular when Mario Draghi comes out and says, we'll do whatever it takes, that's where the money's flowed. And if you look at the valuation opportunities there, Europe actually continues to be favorable, even though there's a lot of headline risks from Greece or wherever it might be from.
Meanwhile, the S&P 500 has done great over the past month. It's far outperforming Europe. And U.S. ETFs are seeing outflows. Do you expect that to change over the summer? I
do. I think investors have been ignoring a bit of the United States because of all the valuation opportunities and all the extraordinary monetary policy that's been popping up overseas. But let's not forget, there's some strength that's actually coming into our economy, moving from Wall Street to Main Street, that continues to propel forward the ability for American companies to have favorable earnings growth.
And in terms of sectors, the energy sector has seen a lot of inflows in 2015. This is after a disastrous end to 2014. Do you expect that to continue?
Energy was a rough ride in 2014, as you say, but in 2015, investors have actually looked for a bottom. Look for the opportunity to step in. There's not a lot of value that folks can find across the markets because they've been on a strong rally, but one clear spot this year has been energy. Looking ahead, I think investors are going to be a little bit more cautious potentially because of where oil might run, but near term, they continue to like the space.
And then finally, $26.3 billion has come into bond ETFs so far this year. And I thought that people were afraid of bonds. You've seen the 10-year tick up to about 2.45%. The end of the great bond bull market, but the money's coming in.
You're right. We've just begun to see the 10-year turn again and maybe a fear of another sort of taper tantrum type environment. But what's interesting is that money continues to flow into fixed income ETFs. Some of it I think has to do with, again, people looking for the fact that fixed income ETFs can offer them liquidity in a market that might not be as liquid as others, but it's also they're not necessarily just going into treasuries. They're looking at high yield. They're looking at investment-grade corporates, even senior loans and convertible bonds now to build that diversification that they need, particularly with rising rates potentially right around the corner.
All right. Thanks a lot, Dave.
Thanks for having me.
And thank you for watching The Street.